Welcome. I'm Adam Taggart, co-founder of Peak Prosperity and now founder of Wealthion. Well, folks, the day has finally arrived. Following this video, my interviews on financial resilience with the world's top experts in money in the markets will no longer be appearing on Peak Prosperity's YouTube channel and are now running exclusively over on the new Wealthion YouTube channel. But before we go, here's the first few minutes of our latest interview with monetary expert Mike Maloney, in which he calculates how high the price of gold should be given the current currency supply. Anybody bothered by the recent flash crash in the precious metals should watch this because it's going to make you feel a lot better. To watch the full interview, as well as all the others we'll release every week going forward, just head over to youtube.com/Wealthion. We'll be waiting there for you.
Hi, I'm Mike Maloney, and I want to congratulate Adam Taggart on putting together such a great set of speakers for his first Wealthion event. This is so jam-packed full of speakers, I don't have a lot of time, so I'm going to get right into it with some headlines from the previous week. Zero hedge. Russia's sovereign wealth fund dumps all dollar assets. Now, anybody that's been following me knows that I've been making presentations on the death of the global dollar standard since 2009, and this is just another one of what I call the nails in the coffin, and they're coming faster and faster these days. Now, before last week, the mix that this sovereign wealth fund had was about 35% dollars, 35% euros, and the other 30% was made up of the yen, the yuan, the British pound, and gold. And today, that mix, as of this week, that mix is being changed. The euro is going from 35 to 40%, but the mix that used to be just 30% now makes up 60%. And the big increases are mostly in the Chinese yuan and gold. So this is huge news, another one of the nails of the coffin in the global dollar standard, and it's just saying that there's some big changes coming. From the Wall Street Journal, Biden's budget signal to the Fed. His economists assume negative real interest rates for a decade. Now, the real interest rate is the interest rate that you're getting on short-term bonds minus, or whatever investment that you've got an interest rate on, minus the rate of inflation. If inflation is higher than the interest rate you're getting paid, then your interest rate is actually negative. So negative real rates through 2031. So this is a decade-long projection that they're basing their budgets and their spending off of. So the rosier they can make this stuff, the smoke and mirrors that they use, the more that they're able to justify reckless spending. Inflation will remain between 2.1 and 2.3%. That's a 0.2% band that they're going to be able to keep inflation ranging between for a decade. Yeah, right. 3-month treasuries will remain below the inflation rate for 10 years. The 10-year treasury will stay below inflation through 2024, never rising above 2.8%, even as the unemployment rate hits 3.8% in 2023 and stays there through 2031. Now, this is a bold statement. Remember this because I'm going to come back to it in a minute. So in 2023, 2 years from now, the unemployment rate is going to go down to just 3.8%, and it's going to stay there for the next 8 years. That's what they're basing all of these numbers on. In other words, the White House is assuming that the Federal Reserve will maintain negative real rates of interest despite 8 years of full employment. So you've got a booming economy, but you're suppressing interest rates and keeping them negative for 8 years, yet somehow inflation will remain contained. These are two mutually exclusive things. There's no place, at least in this universe, that these things can both happen together. Maintain negative interest rates and have full employment for 8 years, a booming economy. So Here is the unemployment rate, and I just generated this yesterday on the Federal Reserve's website. And this goes back to 1948, I believe. And we're supposedly down at 6%, but they're really fudging these numbers to try and get that. There's no way that it's really down at 6%. But I want to point out that the last economic expansion, 10 years and 6 months, was the longest in history. The one preceding that was the second longest now, is this one from 1992 to 2001 or 2002. And what you see here is that it hit 3.8% here and then eventually went down to 3.5%, or 3.8% here. But in order to see 3.8% again, there was April of 2000 that it hit 3.8%. And before that, you got to go all the way back into the 60s to get unemployment rates this low. So they're saying they're going to go down to the lowest rates since the 1960s, and they're just going to stay there for 8 years, and they're basing their numbers off of this. So this is an update from a presentation I gave called Early Warning back in 2018, and it's the length of the time between recessions, so it's the economic expansions. And it's a list that goes all the way back to 1854, so you're going back to the Civil War here. And I've put these in order of length, not in order of the time period. And what you see here is that the longest, when I gave this presentation, it was in 2018. That's the reason this says 2009 to 2018. The longest one was 1991 to 2001, and it lasted 120 months, 10 years. And this is, so the average in all of these is 4.5 years. And this is where we were at the time. And I said, this is coming to an end. This economic expansion is very long in the tooth. It cannot go forever. And I was also citing the employment statistics. Unemployment had been very, very low. And so this had to come to an end, because every time unemployment gets down to that area of 4.2%, 4%, 3.8, it means there's a recession coming up just around the corner. That's always been an indicator, is these very low unemployment rates. But then the Congressional Budget Office, or the Cannabis Bogarting Optimists projection, they're smoking something funny to get out to this. They were projecting 240 months, 20 years of economic expansion. So, what they're projecting this time isn't going to happen either, not with the imbalances that we currently have. So this is also an update from the early warning, and I originally did this in 2017, a year before early warning. But I was looking at long-term interest rates and just noticed what appears to be a cycle, and I looked up some charts. The information gets very blocky before the year 1880. But you could see that there appears to be these waves and cycles that repeat throughout history of interest rates bouncing up and down. And what I did was I took the lowest interest rates in a cycle. So when the cycle begins at the lowest, goes up to a peak and returns to the bottom. And it turned out it was the same number of months leading up to the peak as the decline into the next bottom. And you could balance an arrow perfectly on top of that. So with that, I decided I would say, can I make a projection on how long this interest rate cycle is going to go by repeating the same process? And I said that somewhere between 2020 and 2023, interest rates should bottom, and then we'll see a reversal of interest rates, which traps the government and the Treasury and the Federal Reserve. Once interest rates start increasing, the refinancing of the national debt becomes very, very expensive and starts to consume more and more and more of the annual budget. So anyway, let's see where this went since. Since I made this graph originally, this is what has happened since in the last last couple of years. So that's where we are. We're very close to what should be the end of this. There could be one more big dip left, but we're getting down close to zero, and this is long-term interest rates. So these are 30-year and 20-year bonds that we're talking about. We're not talking about 3-month bills, or we're not talking about treasury notes. We're talking about bonds. So it can't stay that way forever. Are we in bubbles? Well, that last chart of interest rates, when interest rates are going down, that's a bull market for bonds. And that went from 1980 until today. So that's one of the oldest bull markets, longest in the tooth, way overvalued and severely, ready for a severe correction. And the higher the cliff, the bigger the fall.
We hope you've enjoyed the first few minutes of this interview with monetary expert Mike Maloney. To watch the rest of this discussion and learn Mike's calculated true price of gold given the current currency supply, and spoiler alert, it's a lot higher than it is today, head over to youtube.com/Wealthion. And be sure to subscribe to the channel when you do. Thanks for watching.